All right, now we're into 8.7 on the cost of home ownership. So what we're going to learn in this section is going to be able to compute the monthly payment and interest costs for a mortgage, prepare a partial loan amortization schedule, prepare a loan amortization schedule using a spreadsheet, solve problems involving what you can afford to spend for a mortgage, and then understanding the pros and cons of renting versus buying. So here we have mortgages. So a mortgage is basically a long-term installment loan, perhaps up to 30, 40, even 50 years, depending on how you work it, and for the purpose of buying a home, and for which the property is pledged as security for payment. Now, the down payment is the portion of the sale price of the home that the buyer has to initially pay to the seller, and then the minimum required down payment is computed as a percentage of the sale price. For example, suppose you decide to buy a home that costs $270,000. The lender requires you to pay the seller 10% of the sale price. So you must make a down payment of 10% of 270,000, which is zero point 0.1 times 270,000 or $27,000 to that seller. Thus, our $27,000 is the down payment. Now, the amount of mortgage then is going to be the difference between what you have for the sale price minus how much you took down for the down payment. So it's 270 minus 27,000 or only 243,000. So that's going to end up being how much you have to take a loan for. Now, the monthly payments for mortgage depend on the amount of the mortgage, which is your principal, the interest rate, and the duration of the mortgage. So mortgages can have a fixed interest rate or a variable interest rate. Now, fixed interest rate mortgages have the same monthly principal and interest payment during the entire time of the loan. However, while the payment itself is fixed, the amount paid in interest actually decreases over time, and the amount applied towards your principal actually increases over time. And so a loan like this has a schedule for paying a fixed amount each period, and this is called a fixed installment loan. Now, a variable rate mortgage is also known as an adjustable rate mortgage or an ARM loan, and they have payment amounts that change from time to time depending on changes in the interest rate. So ARMs are less predictable than the fixed mortgage rates, and they start out lower usually than a fixed mortgage rate, but then what happens is they can go up and up and up over time, although there are cap limits on how high a rate can go over that term of the loan. All right, so although the monthly payments for mortgage depend on the amount of the mortgage, the duration of the loan, and the interest rate, the interest isn't the only cost of a mortgage. Some lending institutions, also known as banks, require a buyer to pay one or more points at the time of closing. That is, the time at which the mortgage begins. Now, a point is a one-time charge that equals 1% of the loan amount. For example, if you have 2 points, that means the buyer must pay 2% of the loan amount at closing. Often, a buyer can pay fewer points in exchange for a higher interest rate or more points for a lower rate. Now, a document called the Truth in Lending Disclosure Statement shows the buyer the APR, or the annual percentage rate for the mortgage. Now, the APR takes into account the interest rate and the points all into one. Now, a monthly mortgage payment is used to repay the principal plus the interest. Now, in addition, lending institutions can require monthly deposits into an escrow account. And this is an account that's used by the lender or the bank to pay real estate taxes and insurance. So you as a person who has a house with a loan on it, usually you're not going to pay those taxes or the insurance directly to the city or the insurance company. You pay it to the bank, they turn around and pay it to those places. And so that's why you have this escrow account. Now, these deposits actually increase the amount of the monthly payment, and so that's what happens. They get more in, and then at the end they can pay out your taxes and your insurance. So they know for sure you're getting the house insured, and they also know for sure you're paying your taxes. All right, so let's stop there and we'll come back with a calculation.